Regina McCann-Hess, President of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to pivot to an education piece. During conversations with clients and friends, I often get questions about various topics related to the financial world and financial topics. And I realize that many people are often asking similar questions. So I would like to be your guide in these topics, and as a result, I'm adding an education piece to the Women in Wealth series. If you think of topics or questions that you would like me to discuss on the Women in Wealth series, please send an email to reginahess@forgewealth.com. Don't be shy. Other people are most likely asking the same questions. And this way we can cover it in the forum and have everybody get a little education piece out of it. Today, our topic is, how are retirement accounts different? Looking at your different retirement accounts now can help you take control of your taxes in retirement. It's not about how much you earn, it's about how much can you spend. Spendable income is what is left after taxes. Different investments produce different levels of spendable income. Tax changes will affect your retirement, whether it's a law or a situation that changes. You may need to be flexible to adapt. A portfolio with a variety of investment types can allow you, your financial advisor, and your tax advisor to take control of your retirement. Let's compare a traditional retirement portfolio with a tax diversified portfolio. A tax concentrated portfolio, a tax diversified portfolio. Okay, we're going to have two different ones there. The tax concentrated portfolio, think of a pizza that you can only cut into 3 slices or 3 sections. The first section is your pension, if you're lucky enough to have a pension. That's section 1. Section 2 is your traditional IRA. Section 3 is your traditional 401k. Now, all 3 sections give you distributions for your cash flow needs. Distributions from all 3 sections, however, will be taxed as ordinary income. So in other words, whatever tax bracket you're in is what you're going to pay for all the income coming out of those sources. Can't control it. Versus your tax diversified portfolio. Now think of a pizza that you can cut into 6 sections or pieces. Your first piece will be your pension, again, if you're lucky enough to have one. The second section will be the combination of your traditional IRA and traditional 401k plans. The third section will be equities that would be in a non-retirement account. The fourth section would be U.S. Treasuries or corporate bonds, again, non-retirement account. Fifth section would be municipal bonds, which could throw off federally tax-free income. And your 6th section, which is very important, is your Roth IRA or your Roth 401k. A tax diversified portfolio provides a variety of distribution options. Some distributions will be taxed as ordinary income. Again, that's going to be your pension, your traditional IRA, your traditional 401k. A second distribution option will be qualified dividends. Your equities inside your non-retirement account could throw off qualified dividends, which are taxed at a lower tax bracket. Third thing they could do would be your long-term capital gains. Again, if you have equities in your portfolio that you have held for more than a year, you could sell them for a long-term capital gain. Again, that is at a lower tax bracket. And then best of all is the 4th option, which will be tax-free distribution. So Roth 401k, Roth IRAs, when you take them income out during the appropriate times, that distribution will be federally tax-free. A beautiful thing. Now, what is tax diversification? I kind of just went through that a little bit, but it's different types of investments, and retirement accounts are taxed at different rates. So I just said some are taxed as ordinary income, some are long-term gains or qualified dividends, and others deliver income that is tax-free. Structuring your portfolio so it generates different types of income is known as tax diversification, which is really, really important. So how are retirement accounts different? The tax treatment of a retirement account overrides the tax treatment of the investments in the retirement account. So for example, a qualified distribution from a Roth IRA is tax-free. The type of investment in the Roth is not a factor. Why diversify? A tax diversified portfolio allows you to change your source of income on the basis of changes in your tax situation. It gives you and your financial advisor and your tax advisor the flexibility to adapt to your changing tax situation. This is going to be really important as you're entering the years for Social Security and Medicare, which, you know, your Social Security could be taxed based on your income. Your Medicare premiums are charged based on your income. And if you can control your taxable income, you can help weather the taxability of that income as well. So how can you diversify? Well, a Roth IRA, you either contribute to a Roth directly, or you could consider converting a traditional retirement asset into a Roth. A Roth conversion is taxable, but qualified distributions from a Roth are income tax-free. So you do want to think about that option. Now, non-retirement accounts, a non-retirement account gives you access to different types of income, tax-free income from a municipal bond, and the often favorable tax treatment of long-term capital gains from selling stocks or fund shares are just two examples. So how can you take control of taxes in your retirement? You can start with a simple exercise. Just take out a yellow piece of paper, you know, yellow writing pad, legal pad, and take a retirement plan inventory to help you see if your portfolio is tax diversified. Inventory your plans so that you and your financial advisor and your accountant can identify opportunities for tax diversification. So in the first column, you want to indicate the owner of the plan. Is it you or is it your spouse? And you also want to write what type of plan it is. Is it a 401k plan? Is it a 403b? Is it a 457? Is it a Roth IRA? A Roth 401k, could be an IRA, could be a SEP IRA, could be a simple IRA. You know, is it an annuity? So an IRA annuity or a non-retirement annuity. So that's in column 1. So in column 2, you want to specify the name and the location of each plan, and then mark whether or not A, you're actively contributing to it, or I, that it's inactive, that, you know, you're not contributing to it anymore, but it is still sitting there being invested. Column 3 will contain the balance of the account and the expected tax treatment at retirement. Your financial advisor can help you with this. You put T for tax-free, O for ordinary income, Q for qualified dividends, and L for long-term capital gains. Then make a separate list of other sources of income and assets. These could include Social Security, pensions, and real estate. You could have income from real estate. This retirement plan inventory and list of potential retirement income sources could be used to have a good planning meeting with your financial advisor and your accountant. Planning now can help you with diversifying your future retirement income and can also help avoid some tax pitfalls. Stay tuned for next educational Women in Wealth series, and thank you for joining us. Again, I'm Regina McCann-Hess, President of Forge Wealth Management. I can be found on LinkedIn as Regina McCann-Hess, and also I'm on Facebook, Twitter, and YouTube at Forge Wealth. And of course, our website is forgewealth.com. Thanks and have a great day.